Why are people so scared of small cap stocks? Is it because they're extremely volatile? Or is it because small businesses are riskier than large businesses? There is a famous saying that risk comes from not knowing what we are doing. So completely ignoring the small caps is a risk in itself. That is the risk of opportunity costs. Because the right small caps can multiply investors' wealth. As per data from financial year 2022, there are more than 6,500 companies listed on Indian stock exchanges. Out of them, only 100 are large caps. Being totally ignorant of the remaining 6,000 plus companies will not make us an intelligent or vigilant investor. Small cap investing can be very risky, especially for novice investors, but there is absolutely no risk in studying them. One big issue with the small caps is that there is not as much information available about them as there is for large caps. Most of these 6,000 plus companies may not even exist 10 years from now. So small cap investing is actually a game of elimination. Screener is a very popular way of eliminating the bad ones, but inexperienced investors cannot solely rely on it. For me, an easy starting point for small cap research is to find out if any big investors are invested in a stock. What's even better is mutual fund holdings. Mutual funds are likely to collect enough information before investing. Another advantage is that small caps with mutual fund holdings have significantly higher liquidity and lower volatility compared to other small caps. So in this video, I will be briefly discussing 5 small cap stocks with high mutual fund holdings. And if you want to become an early investor in this micro cap channel, just click on subscribe. Namaste and welcome to Retail Investing. The first stock is Gateway Distriparks. The company is involved in the export-import industry. They provide services related to warehousing, rail and road transportation, container handling services, etc. 40.29% of the company is owned by the domestic institutional investors, which include famous mutual funds like the Mirae Asset Emerging Blue Chip Fund, HDFC Small Cap Fund, and also the General Insurance Corporation of India. Here is the financial overview of the company. The market capitalization is 4,429 crore rupees, and the price has touched a high of 91.8 rupees and a low of 58.5 rupees in the last 1 year. The price to earnings multiple is 18.5, which is significantly lower than the industry average. The return on capital employed is 12.8% and the return on equity is 14%. These are decent numbers considering the industry in which the company operates. The company has a debt of 486 crore rupees and reserves of 1,243 crore rupees. The dividend yield is healthy and it's a sign of the company's good cash reserves. The quick and current ratios are both 0.68. A higher number would have made me more comfortable. One thing that seems worrisome to me is the huge contingent liabilities of 4,910 crore rupees. Saral bhasha mein, liability means something that takes money out of your pocket. A good example would be the finfluencers. Contingency is an emergency-like situation that is possible in the future. So contingent liability basically means a potential loss to the company only if a bad event happens in the future. Things like lawsuits, warranties, and penalties usually result in contingent liabilities. Gateway Distriparks is in the business of rail and road transportation. Road accidents and derailment of trains could be devastating for the company. The company has reserves of only 1,243 crores against contingent liabilities of 4,910 crore rupees. If we compare that with Hindustan Aeronautics Limited, which is a defense stock, it has huge contingent liabilities of 13,182 crore rupees, but has even higher reserves of 23,172 crore rupees. Theoretically, this means that a few unlucky events could stop Gateway Distriparks from continuing as a going concern. Now, please note the word theoretically, and based on that, do your own risk versus reward assessment. Also consider the tax percentage in your risk assessment. As you can see, the company has paid taxes as high as 47%. And as low as -8%. In the last 2 years, they have paid really low taxes. This indicates that in the future, suddenly they may have to pay very high taxes, which could eat away all their profits. And the market may not like that. The next one is Equitas Small Finance Bank. Here is the shareholding pattern. The promoter holding is 0 because of an amalgamation with Equitas Holdings. Nothing to worry about that. Domestic institutions own 43% of the company. Big mutual fund names like the State Bank of India, HDFC, ICICI and Nippon are investors in it. The small finance banks undertake lending activities in the underserved sections. These include the small and micro industries, the unorganized sector, and small and marginal farmers. It's a very large addressable market, but some would consider lending to these sectors to be on the riskier side. The speciality of the small finance banks is that their operations are high-tech and low-cost. Here is the financial overview of the company. The market capitalization is 9607 crore rupees. The current market price is 85 rupees. The price has touched a high of 101 and a low of 45.8 in the last 1 year. The face value is 10 rupees. So stock splits may come in the future. The price to earnings multiple is 14.4, which is a little higher than the industry average. The book value is 46.4 rupees, which makes the price to book value 1.83. The return on capital employed is 8.04 and the return on equity is 12.2. The quick and current ratios are both 1.33. That seems good enough. But one thing that does not seem good to me is the NPA numbers, that is the non-performing assets. The gross NPA is 2.76% and the net NPA is 1.21%. The ideal NPA for any bank would be 0. But that's not happening. So a below 1% net NPA would be highly desirable. The valuation still seems to be more than reasonable. A majority of the analysts are bullish on the stock. Its CASA ratio is quite strong. Loans given to small businesses and vehicle finance are expected to drive the future growth in credit for the bank. Both these segments are underpenetrated. Many analysts are expecting a loan growth of 25% or more in the next 2 years. High interest rate scenarios are not conducive for banks, especially for small banks. But Equitas Small Finance Bank has shown strong performance even in such scenarios. When the interest rates come down, this bank can be expected to grow very fast. On the negative side, the main factor to consider is the risk for NPAs getting higher. Since the borrowers are from the unorganized sector, the risk of defaults cannot be ignored. We need to look into the details of its customer base to assess the risks. Overall, this bank definitely deserves a closer look. The next stock is Kalpataru Projects International. Domestic institutions hold 42.41% stake in the company. HDFC, ICICI and State Bank of India are some of its shareholders. The company is in the EPC business, which stands for Engineering, Procurement and Construction. EPC is a kind of a contract in which the contractor is responsible for all the activities starting from designing, procuring, constructing to commissioning and handing over of the project to the owner. The union government often uses the EPC contracting method for construction of national highways and expressways. By the way, L&T is the largest EPC company in India. Kalpataru does business in industries like transmission, oil and gas, railways, buildings and factories, urban infrastructure, water, etc. Kalpataru is a global EPC player. It has a presence in all the continents, at least in the ones where people live. One thing to notice is that the company has a heavy presence in Africa. After the BRICS nations, Africa is likely to be the next frontier for global growth. Expanding in Africa shows the company's farsightedness. And it also means India in, China out. The company's international order book is north of 18,000 crore rupees, which is roughly 40% of its total order book. 60% of its order book is from the domestic market. The company has been involved in some notable projects, as you can see. Here is the financial overview of the company. The market capitalization is 10,683 crore rupees and the current market price is 656 rupees. The price has touched a high of 690 rupees and a low of 400 rupees in the last 1 year. The face value is 2 rupees, so stock splits may come in the future. The price to earnings multiple is 26.5, which is almost half the industry average. The company has a debt of 3,786 crore rupees and reserves of 4,688 crore rupees. The return on capital employed is 14.2% and the return on equity is 8.57%. The quick and current ratios are both well above 1. That seems good enough. One thing to notice is that the placed percentage of shares is 47%, which is very high. The next one is Multi-Commodity Exchange of India. Domestic institutions hold a whopping 55% stake in the company. The famous Parag Parikh FlexiCap fund is heavily invested in this stock. As the name suggests, it's an exchange where derivatives of commodities are traded. Derivatives, that is futures and options. MCX is the 5th largest commodity options exchange in the world and the 7th largest commodities futures exchange in the world. It's a monopoly business with 96.8% market share. The company gets 25% of its turnover from trading derivatives of silver, 24.18% from natural gas, 17.95% from gold, and 15.71% from crude oil. Here is the financial overview of the company. The market capitalization is 9,054 crore rupees and the current market price is 1775 rupees at a face value of 10 rupees, and this somehow indicates that the market respects the stock. The price has touched a high of 1876 and a low of 1156 in the last 1 year. The price to earnings multiple is 71.2. The industry PE is being shown 28.1, but MCX is the industry. The company has a debt of 1.55 crore rupees and reserves of 1428 crore rupees. The return on capital employed is 13.2% and the return on equity is 10.3%. The quick and current ratios are both 1.59. That seems good enough. The company's free cash flow has been positive. The PEG ratio of 5.25 suggests that the stock is highly overvalued. But if the market is giving it a premium, there may be some reasons behind it. Only in-depth study can reveal the reasons. The next stock is KNR Constructions Limited. Domestic institutions hold a 33.66% stake in the company. HDFC, State Bank of India and Axis are some of the well-known mutual funds invested in the stock. KNR Construction was incorporated in 1995 and it is in the business of constructing roads, bridges, flyovers and irrigation projects. The company is involved in 3 categories of contracting: engineering, procurement and construction, BOT, which stands for build, operate and transfer, and the hybrid annuity model. The company claims to have a pan-India presence. In the last 20 years, they have successfully executed projects in 11 states. They're calling their presence Pan-India because Pan stands for presence across the nation. Gujarat to Arunachal Pradesh is across the nation. Haryana to Tamil Nadu is also almost across the nation. But still, it's only 11 out of 28 states. So I won't call it Pan-India. Its clientele includes the National Highway Authority of India, Union Ministry of Road Transport and Highways, and many other government entities. Here is the financial overview of the company. The market capitalization is 7,758 crore rupees. The current market price is 276. The price has touched a high of 287 and a low of 203 in the last 1 year. That is not much volatility. The face value is 2 rupees, so stock split may come in the future. The price to earnings multiple is 17.3 against the industry average of 30.7. The company has a debt of 652 crore rupees and reserves of 2714 crore rupees. The return on capital employed is 21.4% and the return on equity is 15.5%. These are impressive numbers for any infrastructure company. The quick and current ratios are both around 2. That seems good enough. So these were 5 small cap stocks with very high mutual fund holdings. Don't forget to type in the comment section on which stock you would like to see a detailed analysis. If you found anything valuable from the video, please like and share. Thank you very much for watching and I'll see you in the next one. Jai Hind.